Have you ever wished for, a fast track to truly understand the complex, rapidly changing world of finance in India? Imagine having the most vital information, the
Mm.
key insights, surprising facts, all from a stack of dense reports, but distilled just for you. Today, we're taking a deep dive into some really significant recent updates. We're looking at the Reserve Bank of India, or RBI, the National Payments Corporation of India, NPCI, and the Securities and Exchange Board of India, SEBI. And these aren't just dry headlines. They're the crucial details that shape everything, from how you manage your money to, well, the stability of the entire financial system. Our mission for this deep dive is simple. Unpack these crucial developments, focus on what's most important and why it matters to you. Whether you're navigating personal finances, prepping for a big meeting, or just really curious about India's economy.
Exactly. And we've sifted through quite a bit of material here. The goal really is to connect the dots,
Yeah.
make sense of how these individual policy changes, these market shifts, how they impact the bigger financial picture, and crucially, how they impact you. And I'd add, for anyone really looking to grasp the regulatory philosophy, the practical implications, maybe especially for something like the RBI Grade B exam, understanding these nuances is absolutely essential. So where should we start? Maybe with digital payments and banking. That's something that touches almost everyone's daily life now.
Okay, yeah, let's unpack that. Let's start with NPCI, the National Payments Corporation of India. They're based in Mumbai, set up back in 2008. Dilip Athbay is the MD and CEO. And they've rolled out some really significant revisions to UPI, the Unified Payments Interface Framework. This impacts how you transact both here in India and internationally. So the first big one seems to be about international QR code payments. As of April 4th, 2025, QR-based international UPI transactions using that QR share and pay method are, well, they're banned. So this means Indian users abroad, including NRIs, they can't scan QR codes anymore if they've just been shared through WhatsApp or social media for payments. Saved or shared QR codes for overseas payments. Restricted now.
Yeah, and what's really insightful here, I think, is the intent behind this change. It's quite nuanced. Because while sharing those QR codes for international payments is out, live, in-person scanning,
Uh,
at physical merchant locations abroad, that's still allowed.
okay.
And that distinction is crucial, right? It tells us NPCI isn't trying to shut down international UPI completely. Instead, they're tackling a specific vulnerability, those shared QR codes. They can be easily manipulated, exploited for fraud, especially when the transaction isn't happening right there face to face.
Right. The risk is higher.
Exactly. So it's really a security move, enhancing security for users while still keeping UPI useful for those legitimate in-person international transactions where, physical presence adds a layer of verification. It feels like a pragmatic balance, trying to weigh convenience against security.
That makes a lot of sense, yeah, focusing on that real-time element. But I'm curious, does this push for in-person verification? Does it imply a trade-off, maybe making it slightly less convenient for some legitimate international transactions that could have used shared QR codes? What's the thinking on that balance?
It's a fair question. And sure, any added friction, even small, can impact convenience. But the data probably showed that the security risks linked to those digitally shared international QR codes were just, well, far outweighing the convenience benefits.
Mm,
For legitimate in-person use, UPI is still incredibly smooth, right? Instant cross-border payments in many partner countries.
yeah.
So yeah, it might affect a niche case, but the bigger aim is hardening the system against these widespread fraud methods. It's a trade-off, definitely, but one that prioritizes financial safety for most users over a specific digital convenience that was becoming a weak spot.
Understood. Shoring up the defenses where they're most needed. Okay. Now, what about domestic transactions inside India? Because there's a new limit there too, isn't there?
Yes, that's right. Within India, there's a new transaction limit of 2,000. And this is specifically on QR share and payments made to non-verified offline merchants.
Okay. Non-verified offering merchants.
Exactly. And this cap, it's a direct measure to curb fraud, particularly in those peer-to-merchant or P2M transactions.
Yeah.
Think about paying small vendors, street hawkers, places where identity verification might not be as strict.
Right.
So this $2,000 cap, it adds a layer of safety for your everyday digital spending. Makes it harder for big amounts to be swiped in one go in a fraudulent transaction. It protects both you, the user, and also helps secure that small merchant ecosystem.
And another interesting change relates to wallet reloads. Merchants are now banned from initiating collect requests to reload prepaid wallets and gift cards. This really sounds like a direct hit against those scams we heard about.
Oh, absolutely. This directly tackles those nasty scam operations. You remember fraudsters would send collect requests to people who weren't suspecting anything,
Yeah.
and they might accidentally approve a big deduction from their bank account to reload some wallet or gift card that wasn't even theirs.
Mm,
Now you, the user, have to initiate the reload yourself. Using push requests, you actively send the money. That gives you much more control, drastically cuts the chance of unauthorized deductions. And if you connect this to the bigger picture, all these NPCI changes, they really show a growing and I think commendable focus on security and fraud prevention, which is essential, isn't it?
yeah.
As India's digital payment ecosystem booms, it attracts new kinds of cyber threats. For anyone preparing for that RBI Grade B exam, understanding these specific fraud types and the regulatory responses like these NPCI rules, that's really key information.
Right. And speaking of digital transactions, there was quite a bit of noise, maybe some misinformation recently about GST on UPI. What's the final word from the government on that?
Yeah, that caused a stir. But the finance ministry came out very clearly. They clarified unequivocally
Hmm.
there is absolutely no proposal to levy goods and services tax, GST, on UPI transactions, not even those above due date 1,000. Any media reports suggesting otherwise. They said those are unfounded, misleading, and this is super important information for almost everyone using UPI, and it directly calms a public concern that really took off.
Why does this matter so much, though? I mean, apart from clearing up confusion, why was the public reaction so strong?
Well, the reaction was immediate and pretty negative, wasn't it? Even at the hint of GST on UPI. What's really insightful, I think, is how this decision reaffirms UPI's unique spot. It's treated almost like a public good, different from other payment systems.
Mm.
Unlike credit cards or even some digital wallets, UPI's zero merchant discount rate, the MDR policy, is key. That means no fee charged to the merchant for taking the payment.
Right, that's been huge for adoption.
Absolutely critical for its explosive growth, especially with small merchants in rural areas. Since January 2020, no MDR on person-to-merchant, P2M UPI transactions. And GST only applies if there's a charge, like MDR. So no MDR on P2M UPI means no GST. Simple as that. The government's basically prioritizing financial inclusion here over potential tax revenue. They understand the broader economic win of a frictionless digital payment system outweighs immediate tax gains. It's a strategic long-term play, cementing UPI as the foundation of India's digital economy.
That's a crucial point. It really highlights the strategic priority on UPI adoption. Now, speaking of empowering people with digital access, let's talk about a group sometimes overlooked, our younger generation. The RBI has stepped up recently, issuing some really interesting revised directions for minor bank accounts, effective April 21, 2025. This feels like a big step. So what does this actually mean for minors?
It is indeed a big step towards both financial inclusion and, maybe more importantly, financial literacy from a young age. Under these new rules, minors aged 10 years and above, they can now independently open and operate their own savings accounts, even term deposit accounts,
Wow, okay.
subject, of course, to specific limits and terms set by each bank. But it empowers them to manage their own money earlier, gives them that practical experience with financial responsibility. And these directions apply broadly. Commercial banks, urban cooperative banks, state co-ops, district central co-ops. Banks have to get their policies aligned by July 1st, 2025, so it should be a smooth transition across the board.
What about kids under 10? Can they still have accounts?
Yes, definitely. For minors under 10, accounts can still be opened, but they must be operated through a natural or legal guardian. And a notable clarification from RBI, a mother can also serve as a guardian, which is an important point in itself. And when a minor account holder turns 18, becomes an adult, banks have specific steps to follow. They have to get fresh signatures, new operating instructions. If it was guardian managed, the bank must verify and confirm the balance. Banks are also told to proactively inform kids nearing 18. Ensures a smooth, clear transition to adult finances. I was quite thoughtful, actually.
And there's a really crucial safeguard built in, too, isn't there, for these young account holders?
Absolutely. This is key. Banks are strictly mandated to make sure minor accounts are never overdrawn, whether run independently or by a guardian. They have to always maintain a credit balance, no going into the red.
Okay.
It's a vital protection for young savers, prevents them from getting into debt early on, helps instill responsible financial habits right from the start.
Beyond the rules, RBI isn't just about regulations, right? They're also actively pushing for digital financial literacy and security, using direct communication channels now. This feels like a very proactive approach to empowering users.
Spot on. The RBI launched its official verified WhatsApp channel, April 12, 2025. It's part of their RBI K-to-High Public Awareness Initiative.
Ah, yes.
The aim is clear: provide real-time, accurate financial info directly to people nationwide, support financial literacy, and critically, fight misinformation and fraud. You can join just by scanning a QR code or searching in WhatsApp. It's very pragmatic, using a platform that's, well, everywhere in India to reach a huge audience directly. Very efficient.
What kind of information are they putting out on this channel? Is it just general advice or more specific?
It's far from general. It heavily emphasizes crucial, practical digital safety tips. For instance, never share confidential banking info, usernames, passwords, CVV OTPs. That's hammered home.
Good.
They warn about unrealistic deals, clicking unknown links in SMS or email. Standard stuff, but needs repeating. Also recommends only downloading apps from trusted sources, using virtual keyboards on public computers, regularly updating passwords. It's quite holistic, covering a lot of common digital threats that target everyday folks.
And QR code frauds, which are a big concern and tie into the MTCI updates, they're specifically addressed too, aren't they?
Indeed, it ties in perfectly. The initiative tackles QR code frauds head-on, advises you to only scan codes from trusted sources, use scanner apps that show the embedded link before you go ahead, install reliable security software.
Sensible advice.
And in case of suspected fraud, the immediate steps are vital. Contact your bank, change your passwords, report it to the police or the cybercrime portal. The real takeaway here, I think, is this move underlines RBI's recognition of platforms like WhatsApp, how powerful they are for empowering you with vital info, especially, as Governor Sanjay Malhotra noted, with the need to bring that remaining 40% of Indian adults into the digital financial fold. It shows it's not just about regulating, it's about educating and enabling people safely.
Okay, and to further boost security, the RBI has mandated all banks to migrate their digital operations to an exclusive domain. Can you tell us about this .bank.in mandate? Sounds like a fundamental shift for online banking.
It is a very significant cybersecurity initiative. Introduced February 7th, 2025, RBI has mandated all banks migrate their digital operations to the exclusive .bank.in domain. And there's a strict deadline, October 31st, 2025.
Okay.
The whole idea is to significantly enhance the security infrastructure of online banking, give you, the user, a safer, more verifiable digital environment. It's about creating a kind of trusted digital identity, specifically for banks.
Who's managing this migration process, and what's the real implication for users like us?
The Institute for Development and Research in Banking Technology, IDRBT, based in Hyderabad, they're authorized by NIXI. Under the IT Ministry, they'll be the registrar for this domain. Banks need to contact IDRBT for technical help during the migration. The crucial implication for you, the user, is this. When you see a .bank.in domain, you'll have an extra layer of confidence. Confidence that you're dealing with a legitimate, regulated bank, not some phishing site trying to scam you. It directly targets that often overlooked, critical layer of security of the website address itself, removes ambiguity, centralizes trust.
Right. Now, moving beyond individual banking, the government's also streamlining how assets are sold, trying to strengthen the whole banking system. What are BankNet and eBCray, and how do they fit into this bigger picture of financial health?
So the Ministry of Finance, MOOF, has launched BankNet, that's Bank Asset Auction Network. It's a new, improved e-auction portal specifically for public sector banks, the PSBs, to help them sell assets more effectively. It was first launched back in January 2025, but now it's got significant improvements, easier lifting, easier auctioning of bank assets. And the main objective, pretty straightforward, speed up the resolution of non-performing asset cases, those bad loans, and just make the whole asset sale process faster.
So it's basically about cleaning up the bank's balance sheets faster. And this isn't a totally new concept, is it? We had eBCray before.
Exactly. It's a direct push to strengthen bank balance sheets, improve efficiency, transparency in recovering assets. And you're right, it builds on previous efforts. The eBCray platform, launched back in February 2019, also aimed to get better value from bank e-auctions. Both BankNet and eBCray come from the Department of Financial Services under MOF. Right now, all 12 Indian PSBs and the Insolvency and Bankruptcy Board of India, IDBI, are actively using the BankNet portal. The strategic insight here. By providing this central, efficient platform for selling off assets, the government is tackling a core problem for banks, getting rid of those legacy NPAs. That frees up capital for new lending, improves overall financial stability.
That brings us nicely into the broader landscape of Indian banking itself. Let's talk about the public sector banks because, wow, the data suggests they've been doing remarkably well lately. What's the story there?
They really have had a stellar run. PSBs recorded a huge 32.7% increase in their dividend payout, reached 27,830 crore in the financial year 2023-24, that's FY24, a big jump from about 21,000 crore in FY23. It's a clear sign of their improving profitability.
And how much of that dividend actually went back to the government given its large stake in these banks?
Roughly 65%, which
Yeah.
comes out to 18,013 crore. That's the slice the government of India got for its shareholding in PSBs for FY24. Compare that to the hero 13,804 crore they got in FY23.
Yeah.
So a decent increase.
Yeah.
And the combined net profit, all 12 PSBs together, hit 1.41 lakh crore in FY24. That's up significantly from 1.05 lakh crore in FY23. It's not just a small improvement, it's a major turnaround for a sector that, faced huge MPA challenges just a few years back.
Were there any standout performers within the PSB group? Any banks showing exceptional growth?
Well, State Bank of India, SBI, was the biggest contributor, as you'd probably expect, over 40% of the total net profit.
Right.
But what's really interesting is the growth in others. Punjab National Bank, PNB, had the highest net profit growth among PSBs, a staggering 228% increase, reaching 8,245 crore.
Union Bank of India, UBI, saw a 62% jump to 13,649 crore. Central Bank of India, CBI, up 61% to 2,549 crore. And there were others with over 50% growth too. Bank of India, 57%, Bank of Maharashtra, 56%, Indian Bank, 53%. Really broad-based improvement.
And what did the RBI's own report say about the overall health of the banking sector? Did it echo this positive trend?
Yes, it did. The RBI's report under Section 362 of the Bank Regulation Act noted that Indian banks overall achieved a return on assets, ROA, of 1.4% and return on equity, ROE, of 14.6% in FY24. And scheduled commercial banks' net profit jumped by 32.8% to 3.49 lakh crore. The real takeaway. This data paints a really robust picture. Health is good, profitability significantly improved in the public sector banking space. It points to successful efforts in cleaning up assets, improving operational efficiency over the last few years. They've moved from fragile to strong. And for those studying for the RBI Grade B, this performance trend of PSBs is a very important macro indicator to get a handle on.
Okay, shifting focus now to rural banking. The government is pushing for a major consolidation with this one state, one RRB policy. What's the strategic thinking behind merging these regional rural banks?
Right, this one state, one regional rural bank policy, announced by the Finance Ministry's Department of Financial Services, effective May 1st, 2025. It involves merging 26 existing RRBs across 11 regions. That's 10 states and 1 union territory. This is actually the 4th round of RRB consolidation, and it brings the number of RRBs down from 43 to 28.
Okay, quite a reduction.
Yeah. The process started way back in 2005, based on recommendations from the Dr. V.S. Committee. The aim has always been towards greater efficiency, stronger capital bases, and basically making these rural banks more viable, more sustainable entities.
So what will these new consolidated RRBs look like structurally? And can you give us a couple of examples just to get a sense of the scale?
Sure. Each new merged RRB will have an authorized capital of 2,000 crore, and each will be sponsored by a major public sector bank. So, for example, in Andhra Pradesh, 4 existing RRBs merged to become the new Andhra Pradesh Grameen Bank, sponsored by Union Bank of India.
Okay.
In Uttar Pradesh, 3 RRBs merged into the Uttar Pradesh Grameen Bank, sponsored by Bank of Baroda. West Bengal also saw 3 RRBs merge into West Bengal Grameenam, sponsored by Punjab National Bank. And many other states, plus Jammu and Kashmir UT, had consolidations too, mostly involving 2 RRBs merging. It shows a widespread effort to streamline that rural banking structure.
And just for context, for listeners who might not be familiar, what's the fundamental role RRBs play in India's financial system? Why were they set up?
Good point. Regional rural banks were set up under the RRB Act of 1976. Their specific mission was to provide credit and banking facilities to small farmers, agricultural laborers, artisans, basically the rural backbone. They are absolutely critical for financial inclusion at the grassroots. They're regulated by the RBI, supervised by NABARD, the National Bank for Agriculture and Rural Development, headquartered in Mumbai. The RRB Act was even amended in 2015 to let them raise capital beyond just the government, making them potentially stronger. Their ownership is unique. 50% government of India, 35% the sponsor PSB, and 15% the state government involved. GOI and the sponsor bank together must hold at least 51%. Now, this raises an important question, doesn't it? How will this consolidation impact financial inclusion and actual outreach in the most remote parts of India? The strategic thinking, the insight here, is that by creating fewer, larger, financially stronger RRBs, the hope is to overcome the limits of the smaller, fragmented banks, leading to better service, better tech adoption, greater sustainability in rural lending. It's aiming for efficiency, hopefully without losing that crucial reach.
Interesting. And related to RRBs, the RBI has also made some decisions about how they manage their pension liabilities. What's changing there, and what's the rationale?
Right, the pension liabilities. RBI has allowed RRBs to amortize, essentially spread out their additional pension liability over 5 years, starting from March 31st, 2025. This means they have to expense a minimum of 20% of the liability each year. It's a phased approach, avoids putting a sudden huge strain on their finances. What's really noteworthy, and I think quite commendable, is that RRBs have to implement this pension scheme retrospectively, back to November 1st, 1993.
Wow, retrospectively.
Yes. It ensures that eligible employees who retired before the scheme was officially introduced still get pension benefits. It treats the scheme as if it was always there during their service. It's about fulfilling a long-standing promise to employees.
And what about the impact on their capital adequacy? Does expensing these pension liabilities weaken their financial standing?
That's a crucial point. The RBI clarified that the Tier 1 capital of RRBs will not be affected by these unamortized pension expenses.
Okay, that's important.
It safeguards their capital adequacy ratios. It's a really pragmatic move, ensuring the stability of these rural banks while they address these past liabilities and honor commitments. Lets them manage a significant financial burden over time without hurting their core financial strength, which is vital for their role in rural development.
Okay, let's talk about something that really affects who gets credit and where it flows. Priority sector lending, or PSL norms. The RBI has made some pretty comprehensive changes here, effective April 1st, 2025. What are the major shifts, and which banks does this impact?
Yes, the PSL guidelines have been revised quite extensively. The goal is to boost credit access to specific sectors considered important for national development. Major changes. While several loan limits have been increased, like for housing loans, the scope of renewable energy loans has been expanded, the list of eligible borrowers under weaker sections is broader now, and importantly, the cap on loans by urban cooperative banks, UCBs, to individual women beneficiaries has been removed.
Interesting.
These revised guidelines apply really broadly. Commercial banks, including RRBs, small finance banks, SFBs, local area banks, LABs, and primary UCBs, though not salary earners banks. So it's a wide-ranging policy update.
What are the specific targets set for UCBs under these new norms? This feels like a significant push specifically for the cooperative banks.
It absolutely is. UCBs now have to achieve an overall PSL target of 60% of their adjusted net bank credit, A and BC, or the credit equivalent of off-balance sheet exposures, CUOBSE. That's from FY 2024-25. And this target escalates to 75% by FY 2025-26. There were interim targets too, 60% for FY 24 and 65% for FY 25.
So quite aggressive targets.
Very much so. And the breakdown within that overall target for UCBs is also specific. 60% total PSL, 7.5% for microenterprises, and 12% for advances to weaker sections. These targets really underscore the RBI's expectation that UCBs play a much larger role in financial inclusion going forward.
Can you give us a few examples of how these loan limits have actually been enhanced across different sectors? The details really matter here for understanding the impact.
Definitely. Let's take housing. That's a big one for many families, right? Yeah. Previously, say in a large metro city, getting a priority sector loan for a home might have been capped around maybe 35 or 40 lakh. Now, for cities with over 50 lakh population, that limit jumps to 50 lakh, provided the dwelling unit itself costs up to 63 lakh.
Okay, that's quite a jump.
It is. What this means for you, the potential homeowner, is that a much larger chunk of your home loan, even for a moderately priced flat in a big city, can now fall under PSL. That could mean better interest rates or simply make it easier for banks to lend in that bracket. It's a direct acknowledgement of urban housing affordability issues.
That's a tangible change for city dwellers. What about other key areas like, say, education or green energy?
Good question. For education loans, up to 25 lakh is now eligible for PSL classification, and that includes vocational courses too.
Ah, vocational too.
Yes, which is crucial. It emphasizes skill development alongside traditional degrees. For renewable energy, limits are enhanced, up to 35 crore for power generation or public utilities, and up to 10 lakh for individual households.
Oh, yeah.
This signals a really strong push for green finance, both at the large project level and encouraging individuals to adopt solar or other clean energy tech at home.
And you mentioned the weaker sections category has been expanded. Who does that include now?
Yes, that category is significantly broader. It now includes artisans with individual credit limits up to 2 lakh. It also includes self-help groups, SHGs, joint liability groups, JLGs, and specifically mentions transgenders. This is alongside individual women beneficiaries, where, as I mentioned, UCBs now have no lending cap.
That feels quite progressive.
It is. It's a step towards ensuring credit reaches genuinely marginalized and underserved parts of society. The overall implication here: these comprehensive revisions aim to strategically channel credit towards critical sectors and populations that need it most. It's a cornerstone of India's inclusive growth agenda. For anyone studying public policy, banking, understanding the fine print and the why behind these PSL changes is absolutely vital.
All right, let's shift to the broader economic steering wheel. Let's discuss the Reserve Bank of India's Monetary Policy Committee, the MPC, decisions. The 54th MPC meeting just wrapped up. What were the key takeaways from this really critical gathering?
Right, the 54th MPC meeting, held April 7th to 9th, 2025, chaired by Governor Shri Sanjay Malhotra. The big news was the unanimous decision to cut the policy repo rate by 25 basis points, down to 6.000% effective immediately.
Okay, a rate cut.
Yes. And the repo rate, as you know, is the rate at which commercial banks borrow from the RBI for short-term needs. So a lower rate means cheaper money for banks, which should ideally mean lower lending rates for consumers and businesses, boosting activity. Alongside this, the standing deposit facility SDF rate was adjusted down to 5.75%, and the marginal standing facility MSF rate and the bank rate were set at 6.25%. It marks a clear shift.
And what about the RBI's overall policy stance and their economic forecasts for the coming financial year? Did those change too?
They did. The RBI shifted its policy stance from neutral to accommodative.
Accommodative, okay.
This signals that the central bank is now leaning more toward supporting economic growth, even if it means tolerating inflation slightly higher within its target range. They revised the GDP growth forecast for FY 25-26 down slightly to 6.5% from 6.7% previously. They gave quarterly breakdowns too: Q1 at 6.5%, Q2 at 6.7%, Q3 at 6.6%, and Q4 at 6.3%. For inflation, CPI inflation, they're projecting 4.0%, right in the middle of the target band of 2% to 6%. Quarterly forecasts are Q1 3.6%, Q2 3.9%, Q3 3.8%, and Q4 4.4%. Worth noting, core inflation excluding food and fuel did tick up slightly to 4.1% in February 2025, mostly because gold prices spiked. And just for context, other rates remain unchanged. Reverse repo at 3.35%, CRR at 4.00%, SLR at 18.00%.
So the big question on everyone's mind, how will this 25 basis point cut in the repo rate actually, ripple through the economy? Will it really lower my loan EMIs? How much will it boost growth?
That's the million-dollar question indeed. While a 25 basis point cut should ideally lead to lower lending rates and cheaper EMIs, the real impact depends on transmission. How quickly and how fully do banks pass on this benefit? We've seen in the past transmission isn't always immediate or complete, especially if liquidity is tight.
Right.
The deeper insight here, I think, is that this move signals the RBI's confidence. Confidence that inflation pressures are largely under control. Their focus is shifting more decisively towards growth now. It's a calculated move, injecting a bit of stimulus, hoping to spur consumption and investment without reigniting prices. It tells us the central bank believes the worst of the inflation fight might be behind them, for now at least. For the RBI Grade B exam folks, understanding this forward-looking element, the signaling aspect of monetary policy, is absolutely critical.
Okay. Digging a bit deeper into liquidity management now, the RBI has also made changes affecting standalone primary dealers, or SPDs. How are they enhancing liquidity access for these SPDs? And remind us, what exactly do SPDs do?
Right, SPDs. These are entities licensed by RBI to underwrite and trade government securities, GSECs. They're key players in the GSEC market. The big change is that RBI now permits SPDs to participate in all repo operations, irrespective of the tenor.
All of them, okay.
Yes. Before, they were mostly limited to overnight liquidity, had restricted access to longer-term variable rate repos, VRRs, and were shut out of the marginal standing facility, MSF. So this is a significant expansion of their access to funds, gives them much more flexibility. Plus, effective April 2nd, 2025, RBI increased the total limit available to SPDs under the Standing Liquidity Facility, SLF, from 10,000 crore up to 15,000 crore, provided the repo rate. Individual limits will be told separately.
Why is this change important, though, especially for the broader market? What's the impact, say, on government borrowings?
It's crucial because, remember, the liquidity situation wasn't great. A shortfall of about 1.58 lakh crore as of March 2025. So these changes help SPDs manage both short-term and long-term liquidity needs much better. And since SPDs are key in ensuring liquidity in the GSEC market, supporting government borrowings by underwriting auctions, well, this helps them do their job more effectively.
Okay.
It's important to clarify, though. When RBI lends to SPDs via SLF against collateral, it's providing liquidity. It's not indirectly buying government bonds.
Right, that's different from OMOs.
Exactly. RBI buys GSECs during open market operations, OMs, or secondary market purchases as a separate monetary policy tool. Think of SPDs as vital intermediaries, market makers. Giving them more flexibility helps support GSEC auctions, manage cash flows better, improves overall liquidity transmission, makes government borrowing smoother, potentially cheaper.
Okay. Now, something that hits closer to home for almost every bank account holder, ATM withdrawal charges. What are the latest revisions from the RBI? What does this mean for our wallets?
Yes, the ATM charges. RBI has revised them. The good news first. You still get your 5 free ATM transactions per month at your own bank's ATMs.
Okay, that's unchanged.
And at other banks' ATMs, it's still 3 free in metro areas and 5 free in non-metro areas. That hasn't changed either. However, once you go over your free limit, each additional ATM withdrawal will now cost 23.
Up from €2.
Up from 21 previously. So, yeah, that quick weekend cash withdrawal might cost you an extra 2 rupees if you've used up your freebies. It's a small jump, sure, but for those of us who watch those free transaction limits, it's a bit of a nudge, isn't it? Plan your cash needs better.
Huh. Yeah, maybe.
These revised charges also apply to withdrawals from cash recycler machines. But importantly, they don't apply to cash deposit transactions through those machines. And the interchange fee, what banks pay each other, stays the same. 17s for a financial transaction, 46 for non-financial, everywhere.
Okay. Shifting gears again, let's look at how the RBI is addressing financial health and stability. Specifically, stressed assets and co-lending. These sound like efforts to really bolster the banking system's core strength.
They absolutely are. First, stressed assets.
Yeah.
RBI has decided to enable the securitization of non-performing assets, NPAs, using a market-based mechanism, the Special Purpose Entity, or SPE, route.
Okay, how's that different from now?
Well, currently, only asset reconstruction companies, ARCs, under the Sarfeesi Act, handle NPA securitization. This move opens it up, based on feedback from a discussion paper last year. A draft framework is out for comments now. It suggests a broader, more market-driven approach to dealing with bad loans. Then there's the co-lending framework, CLM. RBI significantly expanded this. It's not just banks and NBFCs anymore. It includes all regulated entities and all loan categories.
All categories, wow.
Yeah. The whole idea behind CLM is to boost credit flow to underserved sectors by combining the bank's lower cost of funds with the NBFC's wider reach. A kind of lending synergy.
What other key draft guidelines has the RBI issued recently to sort of streamline lending practices?
Well, they've also issued draft guidelines for lending against gold collateral, aiming for a harmonized framework across all regulated entities, addresses prudential risks, ensures fair treatment for customers, standardizing practices in a really important lending segment.
Makes sense.
Separately, draft directions came out for non-fund-based credit facilities, things like guarantees, letters of credit. Again, establishing a consistent framework for all regulated entities creates consistency, transparency for products that aren't direct cash loans but still carry significant financial commitment.
And what about fighting financial fraud? That seems to be a constant battle in this digital age.
It really is. Deputy Governor Swaminathan J. emphasized RBI's ongoing efforts to improve fraud risk management at banks. Significantly, he mentioned the success of pilots for Mule Hunter AI. That's an AML model from RBIH, the RBI Innovation Hub.
Mule Hunter AI.
Yeah, designed to detect mule accounts used in fraud. He said pilots in large banks have been very effective in spotting frauds.
That's promising.
And on unsecured lending, RBI clarified they aren't trying to push it just to boost credit or consumption. Those higher risk weights on unsecured loans brought back in November 2023. They're simply a return to pre-COVID prudential norms, ensuring responsible lending, preventing excessive risk. The real takeaway here, all these measures together, they show RBI's comprehensive, multi-pronged strategy, maintaining stability, promoting responsible lending, fighting fraud in a dynamic economy, constantly adapting.
Okay. There's also been a pretty major policy shift regarding the gold monetization scheme, or GMS. What's happening with the medium and long-term government deposits, the MLTGDs, under this scheme?
Right, GMS. The government of India decided to discontinue the medium and long-term government deposit MLTGD components, effective March 26, 2025. So what this means is no new gold deposits will be accepted under MLTGD anymore, not at the collection centers, not by the agents, not at designated bank branches.
Okay, so no new deposits. What about existing ones?
Existing MLTGDs will continue until they mature and are redeemed. But, importantly, renewals were also stopped from March 26, 2025. It signals a clear change in direction.
Was anything else discontinued around the same time that gives us more context here?
Yes, good point. Earlier in 2025, the central government had also discontinued the sovereign gold bond, or SGB, scheme. So this fits into a broader pattern. The gold monetization scheme itself, remember, was launched back in September 2015. The main aim was to reduce India's reliance on gold imports, get all that gold held by households and institutions mobilized for productive use.
Right. Unlock the value.
Exactly. It replaced the old gold deposit scheme from 1999. All scheduled commercial banks except RRBs could participate. Depositors could be resident Indians, HUFs, trusts, mutual funds, ETFs, companies, even government entities. Minimum deposit was 10 grams raw gold, no maximum limit.
Can you quickly break down the components of the GMS for us, especially now that part of it is being discontinued?
Sure. GMS basically had two main parts. First, the short-term bank deposit, or STBD. Interest rates set by the banks themselves, premature withdrawal allowed, tenure 1 to 3 years. This part, it remains active.
Okay, SDVD continues.
Yes. Then there was the medium and long-term government deposit, MLTGD. This is part now discontinued for new deposits. Under MLTGD, interest rates were set by the central government, notified by RBI. For example, the medium-term MTGD was 5-7 years tenure at 2.25% interest per year. Withdrawals allowed after 3 years. The long-term LTGD was 12-15 years tenure at 2.50% per year. Withdrawals allowed after 5 years. The crucial insight here. This discontinuation marks a really significant shift in the government's strategy for managing gold assets.
Yeah.
Moving away from these direct government-backed deposit schemes. It suggests a rethink, maybe, on how best to channel gold into the formal economy, perhaps favoring other investment routes or a more market-based approach now.
Right. Let's broaden our view now, look at India's position in the global financial arena. First up, how are India's external debt dynamics looking? Is the country taking on more debt? What's the mix?
Okay, external debt. India's external debt rose to USD 717.9 billion by December 2024. That's an increase of 10.7% from USD 648.7 billion in December 2023. So, yes, it's gone up.
And the debt to GDP ratio?
The external debt to GDP ratio stood at 19.1% in December 2024, a slight increase from 19.0% in September 2024. This ratio was key, shows the country's capacity to handle its debt. Long-term debt maturity over 1 year makes up the bulk, USD 578.3 billion in December 2024. Short-term debt share did increase slightly to 19.4% of total external debt, up from 18.9% in September 2024. An interesting detail, there was a valuation effect of USD 12.7 billion because the US dollar appreciated against rupee and other currencies.
So not all of the increase was new borrowing.
Exactly. Some of it is just currency fluctuations making existing dollar debt look larger in dollar terms.
And what about the currency mix of this debt and the types of instruments? Who holds most of it?
The US dollar debt is still the largest chunk, 54.8%, shows significant exposure to the US currency, followed by the Indian rupee at 30.6%, Japanese yen 6.1%, SDR is 4.7%, and the euro 3.0%. By instrument type, loans are the biggest portion at 33.6%. Then currency and deposits, 23.1%, trade credit and advances, 18.8%, and debt securities, 16.8%. In terms of who holds it, the central government's share of external debt actually went down.
Oh, interesting.
While the non-government sector's share increased, the debt service ratio principal and interest payments versus current receipts was 6.6% in December 2024. The crucial question this raises is, how does this rise in non-government external debt impact India's financial risk profile? It points to maybe a greater reliance on private sector borrowing from international markets, which can have different risk dynamics compared to sovereign debt.
Okay, beyond debt, what about India's international investment position, the IIP? What does that tell us about assets versus liabilities with the rest of the world?
Right, the IIP. Data for Q3 of FY25, that's December 2024, shows net claims of non-residents in India increased by USD 11 billion, reach USD 364.5 billion. Basically, foreigners' investments in India minus Indian residents' investments abroad, that gap grew. Foreign assets held by Indian residents actually declined by USD 40.1 billion, while claims of non-residents in India decreased by USD 29.1 billion. Net effect was an overall increase in India's total foreign liabilities, the decline in foreign assets, mainly due to a big USD 70.1 billion reduction in reserve assets held by the RBI. Though reserve assets were still up by USD 13.2 billion compared to December 2023, which helps stabilize things a bit.
And how did the overall ratio of assets to liabilities change? And what's the latest on India's current account deficit, the CAD?
India's international assets to international liabilities ratio actually improved slightly to 74.7% in December 2024 from 73.1% in September 2024. So assets grew a bit faster relative to liabilities in that quarter. Regarding the CAD, the difference between money flowing in and out, India's CAD increased modestly to USD 11.5 billion, or 1.1% of GDP, in Q3 FY25. That's up from USD 10.4 billion in Q3 of the previous year.
Okay, a slight increase year on year.
Yes, but it moderated quite a bit from the previous quarter, Q2 FY25, when it was USD 16.7 billion, or 1.8% of GDP. Why the sequential improvement? Mainly higher software services income and strong remittances from the Indian diaspora. India's foreign exchange reserves, though, declined by USD 37.7 billion on a balanced payments basis in Q3 FY25. That contrasts with an increase of USD 6 billion in Q3 FY24. So these figures together give a pretty comprehensive snapshot, generally stable but definitely fluctuating external sector dynamics.
Okay. And what about outward remittances? Money Indians send abroad under the Liberalized Remittance Scheme, LRS. Are people sending more or less money out? And what are they using it for? This gives a unique window into individual choices.
Right, LRS remittances. They actually declined by 8.21% year on year, down to USD 27.02 billion from USD 29.43 billion in the April 2024 to February 2025 period.
So a drop overall. What about the category?
International travel is still the biggest chunk, reflecting global mobility, but remittances for maintaining close relatives. That saw a sharp drop, almost 22% year on year. And overseas education remittances, also down by 16%. These are significant shifts in the traditional categories. Something's changing there.
Those are big declines in traditional areas. Were there any categories where remittances actually grew, suggesting maybe some new trends emerging?
Yes, exactly. And this is quite telling. Overseas remittances for buying immovable property rose significantly by 28.32%.
Wow. Property buying abroad is up.
Yeah. And investment in overseas equity and debt instruments also increased by 8.27%. So remember, the LRS scheme started in 2004. Lets resident individuals send up to USD 250,000 out per year for permissible transactions. The limit used to be way lower, just $25,000 initially. The fascinating insight here, these shifting patterns within LRS, decline in traditional things like education, maintenance, but a rise in property and equity investments abroad. It offers a really interesting snapshot, doesn't it? Evolving Indian wealth, changing global aspirations. Suggests maybe a growing interest among Indians to diversify assets globally, maybe gain exposure to different markets or currencies.
Absolutely fascinating trends. Okay, let's turn now to SEBI, the Securities and Exchange Board of India. Their vital role in market regulation, investor protection. They've introduced stricter disclosure norms for IPOs and for foreign portfolio investors, FPIs. What are the key changes here?
Right, SEBI tightening things up. For initial public offers, IPOs, when a company first goes public, they brought in stricter rules for disclosing key performance indicators, KPIs. Companies now have to provide really clear, unambiguous definitions for their KPIs. They need to include non-traditional financial metrics if they're relevant to how the company is valued. And there needs to be enhanced oversight from the audit committee and the board on these KPIs.
So more than just standard financials.
Exactly. KPIs help investors evaluate performance, assess risks, compare companies beyond just the usual profit and loss. What's explicitly excluded are things like sensitive business data, stuff you can't verify, forward-looking projections, keeps it grounded and reliable. All disclosed KPIs must be approved by the audit committee, certified by a professional. And even after listing, companies have to keep disclosing these KPIs periodically annually or until the IPO money is fully used, whichever is longer. Ensures ongoing transparency for investors like you.
Okay, that's for IPOs. What about foreign portfolio investors, FPIs? What new disclosures are required from them?
For FPIs, SEBI has doubled the investment threshold that triggers granular beneficial ownership, BO, disclosures. It used to be 25,000 crore. Now it's 50,000 crore.
Okay.
So FPIs holding over 50,000 crore of equity assets under management, AUM, in Indian markets. They now need to make these additional disclosures. This also applies to subscribers of offshore derivative instruments, ODIs. There are exemptions, of course, for broad-based pooled funds, government-related investors under certain conditions. Connecting the dots here, both these measures for IPOs and FPIs, they aim to significantly boost transparency, ensure that you, the investor, get clearer, more reliable information to make decisions, bolsters market integrity, protects retail investors.
SEBI is also focusing on enhancing market integrity through new rules on conflict of interest and trading windows. What's the latest on that front? Sounds like a direct response to insider trading concerns.
It seems precisely that. SEBI approved forming a high-level committee, HLC. Its job is to review governance provisions, revamp the rules around conflict of interest, and disclosure obligations for board members and senior management. This decision came during SEBI's first board meeting under its new chairperson, Duhin Kantapende. It's a 6-member HLC, chaired by Pratish Sinha, who's a former Chief Vigilance Commissioner. They're expected to report back within 3 months. That signals a serious, fast-track push for better corporate governance, higher ethical standards.
And specifically on preventing insider trading, how are they tightening up those trading window rules?
SEBI's new guidelines from 2025 significantly strengthen the automated trading window closure system. The big change. It now extends to include the immediate relatives of designated persons, DPs, in listed companies.
Relatives too.
Yes. The goal is crystal clear. Restrict trading by anyone who might have unpublished, price-sensitive information, UPSI, especially around results announcements or major events. Listed companies now have to upload detailed info on DPs and their relatives' PAN, names, DIMIT numbers to a designated depository portal. And they have to do it at least 2 trading days before the trading window closes. It's a proactive measure. Makes compliance easier to track, makes it much harder for people with inside info to profit unfairly.
There are also changes regarding officials at market infrastructure institutions, MIIs, the stock exchanges, clearinghouses, the market backbone. What's changing for them?
Right, MIIs. SEBI introduced changes for appointing public interest directors, PIDs, and also for the cooling-off period for key management personnel, KMPs, and directors at these MIIs. PID appointments still only need SEBI's approval, not shareholder approval. That stays. But the MI's own governing board will now decide the cooling-off period for KMPs and directors before they can join a competing MEI. SEBI won't prescribe it for PIDs anymore.
Okay, more internal decision-making there.
Seems so. The MII board will also approve appointments for key roles like compliance officer, chief risk officer, chief technology officer. That used to be the nomination and remuneration committee. And if a PID isn't reappointed, reasons have to be recorded, sent to SEBI. The overall insight here: these moves show SEBI's continuous effort, tightening governance, preventing insider trading, ensuring a fair, robust market for everyone, from big institutions down to individual investors.
Okay. SEBI's also brought reforms for investment advisors, IAs, and research analysts, RAs, plus new rules for the futures and options market. Let's tackle these, starting with how IAs and RAs can charge fees now.
Right. SEBI's given investment advisors and research analysts more flexibility here. They can now charge advance fees for up to 1 year.
1 year advance. Okay.
Yeah. Previously, IAs could only charge for up to 2 quarters ahead, RAs for just 1 quarter. So this offers more predictability for both the advisor and the client. Important note, these fee rules only apply to individual and HUF clients. Non-individuals, accredited investors, institutional clients. Their fee structures are governed by bilaterally negotiated contracts, recognizes their different scale and needs.
What about the futures and options F&O market? It can be pretty volatile. What measures are being proposed there to manage the risks?
SEBI's proposed several new ledgers for the F&O market, aimed at monitoring risks better, regulating open interest OI formation to manage volatility. Proposed changes include limiting weekly expiries to just 1 per exchange.
Limiting weekly expiries.
Yes. Increasing contract sizes, potentially to reduce excessive speculation by smaller players, collecting premium up front to ensure sufficient margins are always there, and removing calendar spread benefits on expiry day itself to minimize potential market disruptions around expiry. These are quite significant moves aimed at enhancing stability, preventing excessive leverage, which can be really damaging in volatile markets.
And what about intraday trading monitoring and cybersecurity compliance? Any updates there?
Yes. SEBI issued new guidelines for better intraday monitoring of position limits, specifically for index derivatives. No immediate penalties if existing limits are breached during the trading day, but new higher intraday limits are set alongside the end-of-day ones. For index options, end-of-day limits are 500 CR net, 1,500 CR gross. Intraday limits are 1,000 CR net and 2,500 CR gross. For index futures, end-of-day limit is 1,500 CR, intraday limit is 2,500 CR.
Okay, specific limit set.
Right. Stock exchanges have to jointly create a standard operating procedure, SOP, and inform clients if breaches occur. On cybersecurity, SEBI extended the compliance deadline by 3 months for entities like alternative investment funds, AIFs, depositories, credit rating agencies, CRAs. But the market infrastructure institutions, MIIs, KYC registration agencies, KRAs, qualified registrars, QRs, they still had to meet the original March 30, 2025 deadline. The real takeaway: From individual advice to complex derivatives, SEBI is constantly fine-tuning, adapting regulations to market complexities, protecting participants from systemic risks. It's a proactive regulatory stance.
Finally, under SEBI, there are new frameworks for specialized investment funds, SIFs, and a performance validation agency. What are these all about? How will they benefit investors like us?
Okay, specialized investment funds, SIFs. A new regulatory framework kicked in April 1st, 2025. SIFs are designed to kind of fill the gap between mutual funds and portfolio management services, PMS, a sort of middle ground.
Okay, a new category.
Yeah. As an investor, you need a minimum total investment of 10 lakh across all SIF strategies under one asset management company, AMC, calculated at the PAN level, not per scheme. Accredited investors, AMC employees, are exempt from this minimum. The framework allows SIPs, SWPs, STPs, but it mandates immediate redemption if your investment drops below that 10 lakh minimum due to market swings.
Ah, so you have to maintain the threshold.
Exactly. For AMCs wanting to launch SIFs, they need at least 3 years operational history, average AUM of 10,000 crore or more over the last 3 years. And only one SIF strategy per category is allowed. It's a targeted effort, offering new investment options, but with clear rules and investor protection built in.
And what about making sure performance claims and ads are actually true? That's always a challenge in the investment world, isn't it?
A huge challenge.
Yeah.
So to tackle that, SEBI introduced an operational framework for a new performance validation agency. It's called PAR-VIA, Past Risk and Return Verification Agency. Its main job: curb misleading claims about past financial performance in ads by research analysts, investment advisors, stockbrokers. A credit rating agency, CRA, will be recognized as a PARVA. It'll work with a recognized stock exchange, which acts as the PARVA data center, PDC. Eligibility criteria for both are quite strict. PARVA will set the verification methods, handle disputes, keep records for at least 5 years. They'll display verified metrics, but always with clear disclaimers. Past performance doesn't guarantee future results.
Right, the standard disclaimer, but now with verified data behind it.
Precisely. This new framework really highlights SEBI's dual commitment: product innovation on one hand, but also a very vigilant stance on transparency and accountability, making sure you have reliable, verified info before you invest, vital for building investor trust.
Okay, let's shift now to the final stretch: oversight, compliance, and the future outlook. Starting with how the system tackles financial fraud and also those unclaimed deposits sitting in banks. What's the situation there? How can people reclaim that money?
It's a significant amount, actually. Public sector banks, PSBs, have transferred over 45,000 crore in unclaimed deposits to the Depositor Education and Awareness, DEA, fund. That's between 2019-20 and the end of 2024.
45,000 crore.
Yes. RBI manages this fund, unclaimed deposits. That's balances in savings current accounts inactive for 10 years, or term deposits not claimed for 10 years after maturity. The good news: you or your legal heirs can absolutely reclaim these funds. Just go to your respective bank. The bank verifies the claim, processes the repayment, including any interest due, and then claims reimbursement from the RBI's DEA fund. It's designed to be a straightforward process.
And I think there's a central portal now to help people find these funds more easily. Sounds like a really helpful initiative.
Exactly. To make it much easier, much more user-friendly, RBI launched the UDG AM portal back in 2023. UDGM stands for Unclaimed Deposits Gateway to Access Information.
UDGM.
It's a centralized platform. Lets you search for unclaimed deposits across multiple banks. Currently, 30 banks are on it, covering about 90% of the unclaimed deposit value. You just need to register on the portal. Separately, on the fraud front, RBI held the 8th State-Level Coordination Committee, SLCC, meeting in Gangtok, Sikkim, back in March 2025. Discussions focused on implementing the Banning of Unregulated Deposit Schemes BDS Act 2019 in Sikkim and generally tackling financial fraud. They emphasized using the Sachet portal for reporting unregulated entities, reviewed fraud cases reported via Helpline 1930. It shows this multi-pronged approach: recovering old funds, preventing new scams.
Right. And finally, some major parliamentary reforms recently passed, amending banking laws. What are the key changes from the Banking Laws Amendment Bill 2024?
Yes, this bill passed Parliament March 26, 2025. It brings landmark reforms across 5 different banking laws. A key highlight for you, the bank customer: you can now appoint up to 4 nominees per bank account.
4 nominees, up from 1.
Up from just 1. Applies to cash accounts, fixed deposits. For lockers, only simultaneous nominations are allowed. But it offers much more flexibility, better estate planning. Another huge change: redefining substantial interest. The financial threshold for having a substantial interest in a bank. It's jumped massively from 5 lakh to 2 crore.
5 lakh to 2 crore. Wow.
Yes, the first change in nearly 6 decades. This is crucial for preventing self-dealing, insider lending, conflicts of interest by directors or major stakeholders. Section 20 of the Banking Regulation Act has special restrictions linked to this. It's about tightening governance, reducing potential conflicts.
What about changes affecting cooperative banks or rules around auditors?
For cooperative bank governance, directors, excluding the chairman and whole-time director, can now serve for 10 years, up from 8. Provides more leadership stability. Also, directors of central cooperative banks can now sit on the board of state cooperative banks. Helps coordination within the co-op structure. Banks also get more flexibility now in deciding auditor payments. Could help attract better talent, lead to more thorough audits, and a practical change. Regulatory reporting dates shifted from the 2nd and 4th Fridays to the 15th and last day of each month. Simplifies compliance for banks.
Okay.
The government also stressed its continued focus on punishing defaulters, reducing NPAs, noting the ED handled 112 bank fraud cases in 5 years. And reinforcing our earlier point, PSBs posted that record profit of 1.41 lakh crore in FY24 with more growth expected. So these amendments together, they enhance financial inclusion, bank governance, accountability, they support NPA reduction, strengthen regulatory oversight, part of the broader financial sector reform push. For anyone tracking the legislative side of banking, these specific amendments are essential to know.
Wow. Okay, we have covered a remarkable amount of ground today. From digital payment security, new rules for minor bank accounts, all the way to strategic consolidations in rural banking, RBI's monetary policy moves.
SEBI's efforts on market integrity, investor protection, insights into India's external debt, those fascinating remittance patterns. Yeah, it's been a lot.
It really has. It shows just how dynamic the financial landscape in India is right now.
Absolutely. Regulators like RBI and PCI, SEBI, they're constantly adapting to new tech, market demands, global economic shifts. And every piece of regulation, every policy change has a purpose, doesn't it? Usually aimed at enhancing stability, security, or financial inclusion for you, the citizen, the market participant. Understanding the nuances, it's not just about memorizing facts, it's about grasping the why behind the what's. That's what empowers you to make sense of the bigger economic story.
Indeed. And as these financial systems become even more interconnected, more complex, the line between global trends and your own personal financial choices gets increasingly blurry, doesn't it? So maybe a final thought to leave with our listeners. How might these recent shifts in India's regulatory and financial landscape equip you, the informed citizen, the informed participant, to not just navigate, but actually thrive in the economy of tomorrow?
I think that ability to understand these changes, to see the why behind the what, as you said, that's the real empowerment. It lets you be proactive, not just reactive in managing your financial future. Maybe even leverage some of these shifts, new investment options, understanding your rights, your protections better.
So keep asking those probing questions, stay curious, and definitely continue to delve deeper into the insights that truly matter for you.